Chapter 1. Ask a Salesperson. If you want to be a better investor, learn the difference between a sales pitch and sound investment advice. Rich Dad. I have $10,000. What should I invest it in? As mentioned in the introduction, for a number of years I really did not know how to answer this simple question. My early replies to this question were awkward, wordy, and rambling. The reason for my inability to answer such a simple question was simply because the appropriate answer is not that simple. We are all different. We come from different life paths, dreaming different dreams. Emotionally, we are wired differently. We have different financial backgrounds and different tolerances to financial risk. In other words, what I would do with $10,000 may not be what you should do with $10,000. In fact, what I did with $10,000 10 years ago is not what I would do with $10,000 today. As Einstein said, it's all relative. Finally, after being asked the same question enough times, I came up with an answer I believe is appropriate. Today, when asked the question, I reply, if you do not know what to do with your money, put it in a bank, and do not tell anyone that you have money to invest. The reason I say this is because if you do not know what to do with your money, there are literally millions of people who do. When it comes to money, everyone has an opinion and advice on what to do with your money. The problem with advice. The problem is that all advice is not good advice. In recent stock market crashes, millions of people have lost trillions of dollars, many because they listened to advice from so-called financial experts. The irony is, most of these financial experts are still handing out advice today, and people are still listening to them. During some of the worst stock market crashes in the history of the world, financial experts were advising people to keep their money in the market. Rather than sell, the experts told them to keep buying, and many people did keep buying, all the way down to the bottom. There is an old saying that goes, when taxi drivers are handing out stock tips, it's time to sell. Maybe that statement should be expanded to include financial advisors. Voices of Sanity. During the insanity of the boom between 1995 and early 2000, two voices of sanity were Federal Reserve Chairman Alan Greenspan and Warren Buffett, reportedly the world's greatest investor. Mr. Greenspan warned of irrational exuberance, and Mr. Buffett simply stayed out of the stock market. During the boom and the bust, Warren Buffett's name was often used in reference to smart investing. Financial advisors used his name as the authority figure as to why a person should get into the market. Financial advisors were saying, Warren Buffett this and Warren Buffett that. When Warren Buffett's name was mentioned, people seemed to put more money into the market. What the advisors failed to tell their faithful investors was that Warren Buffett was not in the stock market. In a 2002 interview in Fortune magazine entitled The Oracle of Everything, Mr. Buffett said, I bought my first stock 60 years ago. Of those 60 years, 50 years have been attractive to buy common stocks. In probably 10 years, I've not been able to find anything. One of the reasons he stopped buying stocks was simple. For the 10 years leading up to 2002, stocks were too expensive. I find it interesting that the world's greatest investor could not find anything to invest in, yet millions of first-time investors and their advisors did. Criticizing the world's greatest investor. The article continues, noting that at the height of the boom, many respected financial experts and publications began criticizing Mr. Buffett for not being in the market. One such expert, Harry Newton, then publisher of technology